Welcome. We can jump right into this. We're already live, so we're pretty easy going. Sometimes we get people to join because I just do it last minute. I don't try to do this as a big push so that we get hundreds of people. We just do this to get that out there, and then we can kind of edit and stick it out into the world of the ether and get everybody interested. So, Norman, thank you very much for joining us today. Very excited. I've known you for a few years. We met first at York Angels. Always been a fan of how you do things, and today I get to actually learn a lot more about you and your investment strategies and how you work in this space. So that's very exciting. So maybe to kick things off, why don't you give us an idea, a bit more of your background of where Norman's come from and the great things that you're doing today.
Okay, that's great. So my background, very interesting. So actually, until about 10, 11 years ago, I spent my entire career working for large companies in senior management positions. I was with the Royal Bank for a number of years. I was at Manulife. At Manulife, I was in the senior vice president of the top 28 in the world. So very, senior positions in very large companies, which is sort of very different from, from this space. But interesting enough, along the way, through many years, I felt a little bit sort of like fish out of water. I didn't feel like that was the right place for me. I did well and made good money and all that sort of stuff, but I wasn't into the politics and all those things you sort of needed to really, excel there. And I always had in my mind, I'd like to help smaller companies. And I had even thought through many years ago, maybe I'll leave, go out my own, do some consulting and all that. But the main problem I found in looking at that was that small companies need the help, but they can't really afford to pay what they'd have to pay for, for that sort of expertise. So it was always a bit of a conundrum, and I never really, pursued it. And then in 2008, I left Manulife. At the time my hands didn't have to work. I joke about that sort of, pre that recession, but anyhow, started seeing some interesting investment opportunities. Myself and a partner putting in whatever, 100 grand, 200 grand type of thing. Liked working with the companies, but then also found most of them didn't close. So while I was going through that, a couple people said to me, "Oh, I know someone they're looking for $1 million, whatever, some much larger amount," which was not something I was going to write my own, check for myself. And so I started thinking, okay, interesting. So I evolved from there into turning it into a business. Got registered as an exempt market dealer issue myself, and a few years ago, my son joined me, like private capital, and basically we finance, small companies, basically I sort of come at it two different ways. There's what I do personally, which is more through the angel groups, which tends to be equity. It could be convertible notes or preferreds, but to me it's an equity risk. And then the company, well, it started doing private equity initially. We found over time that became actually very difficult, unfortunately. And the reason was the lack of liquidity. And we heard this through the angel groups about the lack of exits and how many years, et cetera. So, and to give you an example of from a business point of view, when I started, I had some, started with friends and people I knew and then colleagues, et cetera. And I had some people say to me, okay, I'll invest in this one, but before I make a second investment, we'll see how it goes. Well, we tell people 5 to 7 years till an exit. So how do you build it? How do you build an investor base that way? And in fact, I remember a conversation with a particular investor who said that, and that's exactly what he did, except the exit took 9 years. And then he did a second investment. So, very hard to build a business that way. So anyhow, we found, although I started before the recession, horrible timing, the investor appetite, disappeared and then slowly came back every year. We found about 5, 6 years ago that I faced a new obstacle, which was the investor appetite was greater, but there was a big lack of liquidity. And so more and more investors said to me, I've got all this money invested in privates. As soon as something turns, I'll write another check for your next deal, but I haven't seen anything in 4 years. So again, hard to sort of build a business. So on the business side, as opposed to the personal side, we sort of pivoted away from private equity, and we now do debt. And we have hundreds of investors. It's grown tremendously. We do private debt, but we do private debt that could still help a lot of the companies that may be watching this eventually, because we're still targeting companies that are not yet profitable. They're close. They can't be pre-revenue for a debt model, but they're not necessarily, wonderfully profitable yet. They're close. They're getting to break even. We'll help them get over the top. And that's the model we call it venture debt. We're one of the few parties in Canada, it appears, that does that. And we've developed a lot of expertise in doing that. So typically where I am now is I do some equity through the mainly through the angel side, and then I do the debt through the business side. The difference on the business side, because I'm bringing an offering to hundreds of investors, we may end up with a few dozen, whatever, that invest in any particular deal, but we're doing $1 million plus on the debt side, and on my personal side, it's much smaller. But in both cases, I love helping entrepreneurs like to see them, become successful, and hope I can help them a little bit, on that journey.
Amazing. No, I love that. And well, we have a lot of things in common. We certainly love to help early stage companies. I love the fact that you've built another equity route, a debt side. I'm also going to pick your brain now because I have a product that now I realize I should be talking to you about it. And then on the other side of it, going in and work with the angel groups to get in there again in that equity side to help build that up. So I think those are two great different streams and offer two different clientele opportunities to be able to disperse. And when you're looking at a portfolio, you want to split your money up in different ways, different risk levels. So I think that that's commendable on any investor to look at what are the two ways that I can get into this early stage or into diversifying my portfolio. So I really like that. So inside of that, you're looking at debt, you're finding different ways. What got you invested into early stage startups and getting part of angel groups? What kind of triggered that? What got you interested, or what got you into seeing that there was this angel networks and joining one of them to go that far?
I guess initially I was looking at how am I going to, if I'm interested in these types of investments, how am I going to find them, right? I mean, one of the big advantages of an angel group is they have deal flow, right? So member York Angels, member Spark Angels. York, I think they receive 400 or 500 applications a year, and then they screen whatever X percent of that, and they bring to the investors 30, 40 or whatever the number is. But as an individual trying to get into the space, how are you going to get access to hundreds and hundreds a year to look at, right? And so they have the deal flow. And then beyond that, there's a lot of expertise. I may have come in with maybe a bit more experience than some, but because of my financial background. But even for people in my background, there's a big advantage to looking at a company as a group, because it may not be the financial part. It may be this particular product, this particular market segment. There's lots of things that I'll see that I don't know much about. Manufacturing, for example, I've never worked in, and so you always have people in the room who have expertise that they can bring to bear on that, either from just their background. Some is very specific, even to that industry. Some even know these companies. But even if that's not the case, they bring a lot more expertise to bear to help you assess a company, because at the end of the day, that's the most important part of investing, is to assessing the potential of the investment. And no one person can have the knowledge to be able to do a good job on such a wide range of companies in various industries, various products. Some are obviously B2C, some are B2B, some are both. A lot of complexity, and so it's great to have other people that have knowledge that they share as part of that process. So that's why, for those who are not yet participating through angel groups, I would encourage them to look at that avenue, because it's really a great system to provide support. Obviously, the deal flow is one element, but just in terms of actually assessing investments, you'll end up collectively doing a better job than one party can do.
No, that's a good point. You're right. It really does that collective herd. And if you can start to pinpoint who's good at what, it allows you to make a better decision, because you can figure out who is more industry focused, ask them some questions, which will allow you to better suit that startup and saying, you know what, I'm interested. What have you thought of these things? I learned this, help them out, maybe connect them. So it's really a wide open network that allows you to network in, figure out more details, and then that allows you to invest in multiple areas instead of just finance, because that's your background, or whatever things that you're really efficient at. It lets you open up that breadth of investments and get more opportunities.
Absolutely.
Is there any favorite parts, like something you're like, man, I love this, I can't wait, this is the exciting part of startups? Is there something that really gets you going?
Well, sometimes, most startups have some sort of product or service that, we haven't seen before that as a benefit to us as consumers or to society. But sometimes you see one that just sort of, hits that in spades, right? So, so some just maybe stand out that way. And then the other part that I always like and I laugh at is, let's face it, I'm 63. I'm not, the most up to date on all the social media and, what's going on in technology today. I used to be more up to date on stuff years ago. And so, I always laugh when we see stuff at the, Opportunity Intergroup that's really the market is our kids, and the joke is, okay, who's going to evaluate this? Who's going to, call their children first, right? So, and there's, I'm going to mention, I'm not going to spend a lot of time on particular companies, but I'm going to mention one that you're familiar with, Enthusiast Gaming, which is now public, and we've all done very well on it. But the joke of it was, okay, we got to all call our kids, so how smart really are we, So anyhow, but it's just interesting because it just goes to show you that we can and should look at all different market segments and customer segments, even if we're not going to be the customer. And I noticed from my business when I started, I'm looking at something and you think, okay, do I like this product or service? And after a while, I start realizing, well, whether I do or don't, I'm a sample size of one. So really, how useful is that, right? And so you sort of realize how limitations of your own analysis, right? I mean, you're a sample size of one, and if you love it, okay, that's one, and if you hate it, that's one. So you need a broader perspective.
Agreed. And I think it's great too that you brought your son in to help too, because I think that really helps you hit those different age categories, as you mentioned. And he's going to see things a little bit differently than you will if it's on the social marketing, data side versus what you're looking at. And I think that probably carries a lot of value. And we see that just in having 7 groups in our syndication and the people that are screening. The younger people that are doing the deep dive, they have a total different perspective than someone that's been doing it for 20 years. And it makes a big difference because they're going to have more interest in something that's more functional that fits into their realm of everyday tasks versus with somebody else who doesn't use any of that stuff. So I think it's pretty valuable to be able to carry those different age categories or groupings in your business.
No, I agree.
So in this investment world, have you found, you mentioned a few things that you like, that you still diversify? Is there any verticals that you really like to focus more on and that you have more interest to invest in?
So interesting enough, I would say on the, people say you must do a lot of tech, right? And on the business side, we've done some tech companies. I think we're both investors in one or two, but we haven't focused exclusively on tech. And what we find is, particularly for debt, sometimes the less fancy or hot areas, there's lots of opportunities that sort of get ignored, and those companies need help too, right? So we just find through deal flow that we end up with a mixture. And sometimes the hot areas are actually less attractive because the valuations get bid up. Various other factors come into play that often we feel we can make a better investment outside of the hot areas, which is sort of counterintuitive to some people, right? But we're not trying to target particular sectors. There's a few that I've never done oil and gas or mining, even when they were popular. I just feel like they have the expertise to bring that to my investors, be credible. So we're not really excluding much. We didn't do cannabis because we felt our investor pool was sort of pretty conservative and seemed to be a bit polarizing to start doing that. Crypto really isn't a business, but other than those, we haven't really excluded anything. We'll take a look. Sometimes it's a black box. You say, well, it's not for me. I still have to understand it. I have to basically understand the business, or I'm not going to get comfortable. I have to be comfortable and agree with their business strategy. So occasionally we've seen business we love, but we felt the way they were approaching the market, what segments they were focused on, whatever, we just didn't think of the best way to do it. So we might pass. But yeah, we're pretty open to pretty much any industry. The one we haven't approached at all is real estate as an investment, as opposed to tech and all that, right? Real estate, and just because in my particular case, a lot of my investors are in that field, and I just felt like I would have too many conflicts, and we don't need that. So
too much overlap.
Yeah. So we haven't done anything in real estate at this point. So.
Well, you mentioned that there's a comfort level, which I agree with. You really do got to dive in and really understand the company, understand where they're trying to go. And then, of course, the key to this is the strategy and how they're approaching the market. And I guess overall, do you have a strategy on the types of companies or the amount of companies that you're going to invest in every year? Is it like every year I'm going after 5 and I got to try hospitality, and next year I'm going after medical? Or do you have a?
No, it's whatever comes at a time that we feel is that, for the business where it's the debt side, there's a bit of a narrow range in terms of the stage they're at. This idea that they're going to be close to break even is a narrower focus than on the equity side, where it could be pre-revenue, it could be further along. There's a sort of a wider range, right? So we're driven more by the stage of company than by the the sector. But interesting enough, what we find with entrepreneurs is some of them they know but help understand how investors think, which is of course part of your process and very helpful. And we often hear we have a great product, and often they do. And we say that's great, but you have to understand, if we didn't have a great product, we wouldn't be having this conversation. Like, that's really step one, because an average product is not going to succeed, right? So you need a great product to then start filling in the other parts of the equation. Do you have the right management team? Do you have the right strategy? Do you have all these things? Because great products fail and poor products succeed. And why does that happen? Well, it's all these other elements, right? It's the strategy, it's the management team, in some cases financing, but that's often not really, the financing is often not really the biggest factor in why companies aren't successful. It's usually because they haven't, the finance they've accessed, they haven't used as efficiently as possible to make the company progress far enough. Right? So there's a lot of elements to success here, and particularly I tell people that people with poor products can succeed. Doesn't mean I want to invest in them, but they can succeed. They look at me funny, and it just shows you the importance of all these other elements.
That's true. And so I guess that leaves it kind of like an open box, that there's probably a good number of companies that you'll invest on both sides, from the equity side to the debt side each year. Do you also reinvest in these companies as well? Like, do you have a percentage that you hold back in your portfolio to make sure you can reinvest?
Typically, by the way, we typically on the venture debt side, we've done probably 4 a year. We could increase it. It's really a question of seeing the right deals. So we're not really limited. On the private side, I'm doing sort of 1 or 2 deals a year. Part of it is because on the business side, my model is my investor will not see a deal that I don't invest in myself, and I'm typically a large percentage. The amounts are add up significantly. So given the slower turn on the you call it the angel investment side, the amounts and frequency tend to be smaller because that money is going to be sitting longer. The debt does turn, right? It's supposed to turn. We do 3-year loans, right? So it's a little bit easier. So we typically do maybe like I said, maybe 4 a year, but there's no major limit on that.
And you put a percentage in, like, do you do reinvestments as well, because it's important to support?
So we don't sort of go in with the intention to reinvest. So it's happened, but on the debt side, the idea is we do a loan. It's 3-year loan. We get repaid. We have some warrants. If everything's according to plan, we shouldn't need to reinvest, because we come in a stage where it should get them over the top where they're profitable, and they can either then borrow more cheaply, which is great, or they might do further raises if they need it for growth. But they shouldn't be desperate for more funding. So our intention going in is we don't expect to reinvest. On the equity side, for the angels, it's happened on a few. Enthusiast Gaming was one. It's another one I did recently where I've gone in a couple of times, but that was more somewhere between expected or it might happen, right? It wasn't like a down round that there's a problem. It was simply that, they probably they're raising in stages. They probably will need some additional funding a little later. It wasn't a surprise,
Fair enough. Well, it sounds like you've got a good portfolio, though. You've got a good style to where you go at it. You've got two sides. You're balancing them out on where you're making the investments, converting, moving things, sitting it in a little bit longer, and other ones are revolving pretty quickly. When you're going through this, is there a duration it takes for you to make a decision? And what is those over-the-top things that will help you make those decisions on the 4 companies on the debt side or the 2 companies on the equity angel side? What are those extra DD things that you're looking for? You mentioned a couple of things around strategy and maybe the management team. You can refine a little bit more of that, but if someone was looking to come to you, what kind of things do you think are really important?
So on the debt side, obviously we're focused on, can we get repaid? We're taking risks. These companies are not yet profitable. So obviously their projections are quite important, and how credible, we think they're achievable. We all see hockey stick projections. And so, we have, fortunately, a little bit easier. We have some history there. Pre-revenue company, there's no history. Here we have some revenue. You can see how it's progressing. Which customers, if it's B2C, you can actually get the names of the customers. Sorry, B2B. We actually call some customers if it's B2B. We do some calls to customers to understand, why they're buying this product or service, what do they like about it, or there's some things can be improved, all that sort of thing. We sometimes actually get some good competitive intelligence for the company itself as part of those calls. And so that's an important part of it. But at the end of the day, it's mainly what I'll call cash flow lending, where, there may be a little bit of assets there, but we're not really going to get repaid if the company fails. That's not really our source of repayment. It's really cash flow. So we got to be comfortable projections off of us company to either reduce them or do a lower a sensitivity of lower sales, etc. We want to understand if they run into some problems, costs they can cut. We want to understand, what could happen and what our risks are, along the way. So, so there's a lot there, but besides the obvious of understanding the product and the market and the management skills, etc., the whole customer side is very important, right? And are they focused on the right things? We've seen, entrepreneurial teams that sometimes, are spending too much time in areas that are less important, or not enough time in the areas that are most important, or, those sorts of things. So it's, at the end of the day, so much of this is comfort and confidence, right? Because you're handing someone your money, and it's are they going to take it and use it, in the most efficient and effective way, right? And so that's very important. So for example, and I'll mention this to any entrepreneurs that might see this, it's extremely important that you can explain your projections. You can answer questions. Don't stretch any information about the company. Just tell us like it is. If something, if something is, there's a sales proposal out, it's not a sale. Tell us that's what it is. Don't tell us it's a sale, or it's guaranteed or this and that. Because as soon as we find something that has been stretched, it affects our confidence, right? And so you're better off telling it like it is, warts and all, and people understand there'll be warts, right? The companies are at a certain stage, they understand that, they expect that, right? Versus trying to sort of make everything sound too rosy, and that'll usually come back to bite you because people see through that, and then they won't invest, and then you're worse off. So it's very important that people don't stretch; they tell us things like they are.
Tell you like it is. I like the idea around the product side. I think a lot of times investors look at, and you talked about it before, so it is a part of your analysis that you're looking for a strong team, strong strategy, but that the product has a fit, and that you're calling customers up and you're making sure that customer is giving you the raw, dirty facts about this product, why they bought it or why they bought this service. I think that is something that most people don't normally talk to, but I 100% agree with. We've done lots of calls to customers. Why did you buy this thing? I learned a long time ago when I was investing back in 2000 in stocks. when the .com crashed and all that stuff. Someone always told me, invest in the products that you use and learn enough about them to figure out how they operate and work. And so my investments were Nortel, Apple, all in the beginning, because I saw that those products were things that I got behind and things that I liked and I could support, and that I could buy their product and use it. So it wasn't this far-fetched dream of this product is so cool, but no one will ever buy it because it doesn't fit anywhere. So I kind of like that philosophy, but at the same time, you're a customer, but you can also understand what the customer's coming from and how it's solving their problem. So I really like the fact that you put some time into understanding why that service or product's being used.
We even will call suppliers if it's like a key component from a sole source supplier type of thing. I mean, we may speak to the suppliers as well, just to get comfortable there, right?
Yeah, that's good. Yeah, everywhere you can, I guess, if you're being routed everywhere, figuring out where you can nip off that extension cord that's hanging out and just clean things up to get to the right spot, right? It's always about making sure everything's efficient and running the right way. And sometimes suppliers have different insights, how they're paying bills, what they're not doing, what they are doing right, where they see the product going, because sometimes they're helping invest in the product or help build it. So those are all valuable insights. I love that. That's great. So is there any factors that fit outside of DD, outside of the people, the customer service? Is there anything on a paperwork side that you really try to emphasize? Like, you want to make sure that if you're coming in on the angel side that, they've got the shareholders agreements, they've got all this locked in. Is there anything that you specifically want to make sure that they do have because you've been burned or you don't want this to happen to the company?
Well, I mean, certainly we've come across issues, which is not where we start. We sort of say, just tell us how this, what the situation is now. We'll look at the agreements later. Because you want to spend the more amount of time, keep in mind, we don't invest, we invest on the debt side less than 1 in 10 that we see. So you're only, you're in our business, you're not trying, but you sort of have to get to a no quickly. You can't spend a month on a no, it's going to kill you, right? So, so you're dealing with, give us the information first. And, as we go further, we may come back and verify some of it through agreements, but we don't need to read the 100-page agreements first, right? So that's how we operate. But yeah, occasionally we've had, the agreements don't quite support what you're telling us. Again, it comes back to this conference issue. One area that I've seen, it's not one area that's a big factor here, but one area I've probably seen a bit more than others is when somebody has maybe licensed something or there's some sort of shared ownership of some IP. Sometimes what we're being told up front and what's the case with legal agreements isn't quite the same. And that's, again, tell us like it is. If there's some problems up front, let us be aware of it. We might decide to focus there first. But don't have us go through all due diligence, find out, we're at, we're 90% of the way there, that there's something that's a problem. And people walk away very quickly because, again, it's all that confidence, that it's hurt. It's hurt by that, right? So it's a problem we've seen a number of times, unfortunately.
Yeah, I agree. I remember one in particular where I remember we were doing the deep dive and it was a unique and different product. And then we found out that 50% of the product was owned by another company and that they also took royalties, and any new products that they got to take 50% of that new product. And we were like, so what do you actually own here? Like, this is crazy. What are we investing in? So it does become a little bit too much when you spend time at the beginning trying to understand it and they don't share it till the end.
Yeah, absolutely.
Which is unfortunate.
Yeah, one area I do find that companies tend to underestimate is competition. They tend to downplay what the competition is doing, poo-poo the competition, etc. And I would say it's a very important area for investors that they want to, help us understand who the competitors are, help us understand the strengths and weaknesses, but be realistic in your assessment because we've seen another area that I've seen a number of times that's can be a bit of weakness. They said, well, we've got this great product, it's better than this competitor, and I look at the competitor's got 1 million customers and they're starting with 0, right? And sort of say, okay, well, how easy for that competitor to do something like what you've got, right? Some cases it's pretty easy. I said, well, they'll just wait. If they see you having success, they'll copy your product, offer their 1 million customers, and then where are you, right? So maybe a great concept, but sometimes great concepts are not going to be successful for those types of reasons. You've got someone with an entrenched market position that could basically scoop it or block you or whatever it is. I mean, it'd be like trying to compete with Google today, right? So people again,
it spurs on other innovation. So
yeah.
your product could be amazing and not have the amount of clientele that it's looking for, and that's going to spark other companies to create new innovative things. So now you've created your own competition, which is great. Competition is good. It helps from marketing standpoint, helps you get the product out. But if you don't have a strong base, you can lose that really quickly, and they can gain ground much faster than you could if they have a larger base.
So it's really understanding the competitors, understanding their position, understanding how they could react, what they're able to do. And I've seen this a number of times when the entrepreneur was relying on competitor being dumb. And I say, well, you know, people usually wake up. They may not be right away, but they usually wake up. So, you know, it's not where I want to put my money that, you know, you're going to be successful when the competitor, you know, is asleep. It's not a great horse to bet on, right? Could it work? It could, but there's all kinds of risks associated with that. Is
there, when you're kind of going through and assessing this risk on the paperwork side, is there preferred terms that you have? Like you don't want safes, or you're good with safes, you're okay with convertible notes, or you want equity, common shares? So what do you look at? On
the what I call the equity side, because you're not into the form, right? Because whether it's convertible note or not, it's really the same. It's an equity risk. It requires an exit to get money out, etc. As opposed to my debt deals, right? You know, I'm okay with preferreds or convertible notes. I really don't like safes. Sometimes the discounts are pretty weak. Frankly, I usually don't have this choice, because by the time it gets to me, they've already got a structure other people have come in under. But often I'd prefer equity over convertibles, because the problem is with these convertibles is the price is being set later, but I'm taking the risk now. And I don't often think that a 10% discount or whatever it is enough to compensate for that differential in risk over the next couple of years till it might convert. So I actually think a convertible, an investor may often be giving up upside for a little bit of downside protection. So it's actually not my preferred route to have a price set later. I understand why it's done, but it can be to the investor's disadvantage, right? On the business side, again, we have a pretty standard sort of debt structure that we use, and we try not to tweak it very much, because our investors know it very well. So when they see a deal, it saves them a lot of time to know it's a venture loan. There's no changes in structure. I know the structure. It saves a lot of time back and forth. So we've tweaked it a little bit occasionally, like a couple of deals, but really not very much. So we've sort of got it fairly standardized for that reason.
Well, consistency is good, right? People then become more adaptable. They move quicker. So that's what you're looking for. You want to convert within 3 to 4 weeks versus 3 to 4 months. So,
right. And actually, I'll come back to your earlier question. How long is our process, right? And basically, on the debt side, typically, we meet you, and we will complete our due diligence in about a month, and then we'll go to our investors and close another month. So it's reasonably quick.
Yep.
Compared to equity deals, as you know, could take quite some time.
Agreed. Oh, that's good. And do you guys, do you look at leading any rounds in this process, or do you focus strictly on working with the other groups in closing off either debt or equity side?
Okay, Jeff, can I just do a quick response to something here? Sorry to, in the middle of video.
Yeah, go ahead.
We're closing like several deals at the same time, which is why it's been so crazy. And this one literally has to close today, and I just got a question from someone, so I'm just going to refer them off to my son.
Okay.
And
dynamic business. I like it.
It is what it is.
Yeah, it's good.
In fact, I spoke to this person before the call to hopefully avoid this, but I should have said, if you have any, make sure you send it to him. But anyhow, it is what it is. So, okay. Done. Sorry about that.
No, that's good. That's good.
Yeah, so we're pretty quick compared to equity on the debt side. That's reasonably quick. We don't have a fund with the syndicate, so that's one of the reasons it does take us a little bit of time versus a fund where we approve it, we write the check within days. But we have a pretty efficient process. We've done it so many times now.
And
right?
do you look at leading any rounds, or do you?
So of course on the debt side, it's our round, right? It's typically our round, our investors. We've occasionally been with somebody else, institution but they may be providing equity or they may be providing a shred loan or something else in conjunction with our venture debt. But typically our piece is ours, right? We're originating it, we're structuring it, we bring it to our investors. So we're typically always the lead. On the equity side for the angel groups, I haven't typically taken on that role, but it's mostly just because of time.
Yeah.
And maybe one day I'd be able to do more there, but just haven't really had the time.
All right, that works. That works. You're doing lots already. So if you were to look at, I guess, all the companies you've invested in, the companies you've worked with over the years, is there an underlying 1, 2, or 3 things that really stand out in your mind that companies, when they're starting off, they should really look at doing before they take debt, before they take equity or release those? Is there something you can say, and it can be around any of the things you've kind of shared already, but is there something that you really think really drives success in the business that gets you interested? If someone comes to you and they show you X, Y, and Z, you're like, I love this, I'm in. Is there something that really stands out for that?
I think a key factor, just from the angel groups a lot, is how coachable is a management team, right? Many of these are young, they haven't done this before, as opposed to some people that it's their third exit, their third time around. And the ones that have been successful, will listen and learn. And in many cases, some of the most successful businesses over time actually had to pivot. And so you don't listen and learn, you'll be stuck, trying the same thing over and over when it's not succeeding, right? So, and there's a lot of expertise available. Think of the angel groups, for example. So, when you see someone, who's a bit headstrong, they know everything. For an investor, it's a bit of a red flag, right? Because they may know a lot, but things change. And yes, I may not know your industry, but we've got people with decades of business experience who've seen everything, right? So I think the key is, are they coachable? And particularly when it's their first time around in a new business, they're reasonably young. It's a very big factor. I think investors look at is, are they going to listen and learn? Because everybody's going to have some learning to do, to get to that stage of being successful, right? And that's extremely important.
Is there, you've gone through this process, you've gone deep dive, you've learned a lot about the company, you find that you're aligning with a lot of their next steps, you can even make the investment now. Are there things inside of this company, because you found that, they're communicating, they're coachable, so you're really excited about them? What can they do, or what can you do to keep helping them outside of finance? Is there some other things that you look at supporting them with, or can you support them that way? Or you kind of made the investment and now you're looking at other companies. How do you continue to keep that company engaged and helping you know what's going on inside of them? Right.
So for the loans, we have a loan monitoring process because we have to update our investors. And this is a key element that we find that a lot of companies, particularly the angel groups we hear, fall down on, and that's just keeping our investors up to date. And so, we look for, whether it's on the business side or the other side, we look for sort of quarterly update. Doesn't have to be, 10 pages. Tell us how you're doing, financially, successes, failures, etc. Again, tell it like it is.
Yep.
The negative I hear from investors the most, the concern I hear the most, is I don't hear how my investment's doing. And then of course, human nature, they usually assume the worst, right? So as much as it's a bit of a pain, you've got a business to run, you're working 110% of your time, take a few hours once a quarter, put out a note, everybody will appreciate that, they'll understand, where you are, and sometimes they'll say, can I help, etc. So I think that's a very, very, very important element that a lot of companies, unfortunately, fall down on. For us, once we make the investment, we look at, even before making us look at, do we have potential customers we're going to refer them to? So if it's a consumer-oriented product, we bring in a financing, we bring in 30 investors, they're trying to add 200 customers, a week, it's not going to matter, right? It's not going to move their numbers. So they may get a few more customers, but it's not going to really move their needle, right? On the business side, however, we've had cases with, with B2Bs, we have customers of size that we've introduced them to, and they've become customers, and maybe bring in others, and they can be much more substantial. So we've certainly seen the cases of that, and so we try and help that. Of course, helps us, helps the company. Everybody's happy, right? So we certainly have had cases of that happening.
No, that's great. And I think all help works when it's early stage companies. They all need a little bit of support somewhere, and that could be on sales, it could be on legal or connections, networking, whatever, mentoring, which actually brings me to my next, and one of my closer to my last few questions, but because you've talked about coaching and you've talked about all these things that you can do to help support them, do you think the early stage companies or the founders should look at things like getting mentoring or getting supported coaching or building an advisory or a board really early on? Do you think that that's valuable for those companies versus maybe waiting until they're 2-3 years in, they're maybe doing $1 million in ARR, and maybe that's when they start to look at really branching out and getting to that next layer? Is that a better time to do it? Do you have kind of an idea around that?
I think earlier is better because, the ones that don't do it may not get to the $1 million ARR, right? So you want to get, the help earlier. Again, it also depends on how experienced or inexperienced they are. Right? We do see some that are more experienced than others, right? Entrepreneurs. But I think it helped. Now, having said that, it's got to be, if it's one mentor, it's got to be sort of a fit. There's not, not always the perfect fit. An advisory board is a good concept. Some entrepreneurs do it, and they put the names out there to impress investors, but don't really use them effectively. And others really do, take the advice and call them and all of that. So I think used effectively, early can be very helpful because getting to $1 million ARR is not necessarily an easy task. In many cases, that's harder than going from $1 million to $5 million, right? So, I think earlier is better in many situations. Now, recognizing, it's time consuming and all that, but a lot of these entrepreneurs could use more advice. We beyond the monitoring, we also are always available for advice, as companies go forward. Some take us up on it, some don't. We typically find that where they need the most help, if the business is doing, reasonably well, how you get next stage, et cetera, it can be negotiating, customer agreements. There could be small acquisitions, or it could be those sorts of things where they have no experience. And too many just sort of approach it as another business challenge, not realizing how different that is. And so we've seen some problems where people have not gone for advice when they should have, right? And unfortunately, we sometimes get called when it's a bit too late or there's a mess on their hands or whatever. So, these are very, very important, can be very important agreements, and you have to have their expertise at the table to do them properly.
No, that's a good point. And getting as much advice anywhere you can before you sign something is huge. Huge. I think I've seen that a few times, and I shake my head and scratch it and think, man, if that quick 30-second phone call, I would have yelled stop on the phone and put the brakes on and let's reanalyze what you're trying to achieve here, because what you're achieving right now, you're going to lose big time on if we don't take a bigger approach to this. So
one of our companies we financed through a loan, we basically saved the company, a long-established company, not a startup, been doing well for years. Signed a distribution agreement for in this case the U.S. Structured very poorly, and it also almost cost them their company. So and it wasn't necessary. They could have structured a proper agreement and been fine.
Yeah, sometimes I think people too look at taking shortcuts, and when you take a shortcut, if the shortcut's not your shortcut intention and it's someone else's, you tend to find the hard way there. You learn the hard lessons. So being thorough and making sure that you're doing things properly is going to benefit you And really, at the end of the day, you got to keep self-protection in this because your business means everything. It's your business. So,
Yep. And the people have done this, dozens of times. So why not learn from them?
agreed. Yeah, 100%. So, if I could kind of steer this way, we've gone through this whole journey about investing and getting behind these companies and supporting them and communicating, and everybody's kind of working together. You picked the things that kind of really made the success of a startup. Maybe one heartfelt story that you can share of your time from investing where you kind of thought this was a real shot in the dark. You didn't know if they were going to pull through, and boom, they came and they ended up here. Do you have one of those real wartime style startup opportunities or investments that you made that you were just blown away by, and it's a great story that you just love to share because you're super excited for where they came from and where they ended up?
God, hard to think of one.
Well, you can share them all if you want, but I'm just
no.
One
So,
good.
well, sometimes a company could just be they've got a great product or service, but just too early, right? The market's just not ready for them, right? And so I could think of two examples. One company, unfortunately, is not done well because it's surprising to us, but the market's still not there, so I won't focus on that one. But another one is about to take off in leaps and bounds because they were too early, but the market is now just about ready for them. And so it's a company that's developed very sophisticated software, which in layman's terms would be called for pattern making. So what's pattern making? Well, think of, it could be clothing, it could be industrial products, but things with fabrics. And to go from a 3D model today to what exact pieces I have to cut at what sizes in 2D is actually extremely complex. And that's what pattern maker used to do, but those people have all retired pretty much, right? So, and so they developed very sophisticated software that could take that 3D model and figure out exactly the size of what has to be cut, and it factors in that it's for what type of fabric. It might stretch, it might sag, it might this or that. And they've been doing this for other kinds of industrial products for a number of years. So the business has been sort of an okay size, but not particularly successful. Not they're going along, but they're doing okay. And now what's happened is the whole market of being able to order clothing online that fits you and have it made, for you is about to take off. And so they've basically repackage what they have. They have to add a few things for this, but they were 95% there, have years of experience doing this, and have now proven they can do this with incredible accuracy that you will love the fit. So it's just an interesting example where we thought the market for where they were already in was bigger, it is bigger, but we have a lot of companies that are sort of set in their ways. But while they were sort of, trying to make that work better, this other market came along and they, should be in liftoff very, very soon. So
very cool. So the world caught up to them. So they were really advanced on figuring out the world's going to shift into more custom so they can cut costs and be more effective. And long and behold, they were right. And the market just took forever to catch up, and glad they didn't sink. They were able to maintain themselves and still build clientele. And now the world's shifted enough and they're saying, hey, you know what? This actually might be the perfect time for a boom here. So that's pretty cool.
Yeah. So a very interesting one. Yeah.
Well, we're down to our last question, and it's all been amazing. Learned lots, which is very cool. Which I like to do is learn. So the last question, you're gonna have to take out the magic crystal ball and say, where do we see, let's say, the next 12 months to 36 months? Where do you see the investment community and startups going? Is there a specific vertical that you really like that you think is going to take off the next 12 months or 36 months? Or do you think it's more going to be agnostic and there's going to be some shifts that are going to go on, money's going to change? Can you kind of give me some high level ballpark ideas of where you see the world in the next 12 to 36 months?
It's hard to focus on verticals because the world's changing so quickly. But you think of the sort of the AI, big data, elements out there that we're seeing more and more of, and you would think there'll be pretty rapid growth, there. But in general, I think we're seeing short term with COVID, excuse me, we're seeing, investors sort of pulling in their horns a little bit on the equity side, on the private side because of the lack of liquidity, right? So we've seen in our business, some investors have decided to, go on pause for now. Some of their portfolios have been hit. They maybe just wanted to sit on more cash just because of uncertainty. Some, of course, their businesses have taken a step back, et cetera. So that's all temporary, but that's sort of where we are today. The underlying longer-term trend, though, is actually quite in favor of private investing and private equity, because what's happening is people are seeing there's potential higher returns. There's still education to be done, but more and more astute investors are seeing if I give up liquidity, I can get much higher returns. So it's not for my whole portfolio. I need liquidity for some of my portfolio, but I can take a piece of my portfolio. I don't need the money back so fast, and I can potentially get much higher returns. And so there's a long-term trend that we're seeing on the private side. And just an example of that is another part of business I haven't talked about because it's a little bit different, but through some sources we work with, we offer our investors shares in pre-IPO unicorns, very large private companies. Unicorns are $1 billion plus valuation. And we've had good success there. We're just, as we speak, closing an offering of SpaceX, which has gotten lots of attention. Over a number of years, we've done, Spotify and Lyft and some others. But what's interesting about it is the underlying trends there. So there, if you go back 20, 25 years, statistics are there were one or two companies that would qualify. Okay. Now there's 300 or whatever the number is, there's hundreds. And why is that? Well, the private markets have gotten deeper and deeper. More money is going into private equity. So these companies like Uber was able to raise $10 billion before it went public. Years ago, it was impossible. They went public within 5 years of any of the kind of capital because the private markets weren't deep enough. So you're seeing deeper private markets, you're seeing more money going into that. As much as I'm focused on the unicorn here, which is sort of a particular element of that market, some of that is trickling down to the smaller private companies that more money, investors are understanding there's more opportunity there. I just have to be willing to give up some liquidity. It's not for everybody, but for many people, they're willing to take a piece of their portfolio and do that. And the reality is success begets success, right? So the more we see of the enthusiast gamings, for example, is one of the more recent successes that the angel groups have had, the more they'll attract funds. So I do think the longer term trend, as much as we have a short term sort of step back here on investors investing in private equity, the longer term trend I think is still in its favor. And there's certainly good opportunities. And if people can give up some liquidity, it's a great space, and a great way to participate would be through someone, could be our type of thing with debt deals where you don't have the expertise, but we bring that to bear. Or on the pure equity side, the angel groups are a terrific avenue to get there, because the collective knowledge and expertise and experience that they have really reduces your risk, in doing this. So I do think, the trends are in our favor longer term, but maybe in the very short term, not so much. But another way to look at it is, where were these angel groups 10 years ago versus today, right? They've grown by leaps and bounds because of these factors.
No, that's awesome. And I think, again, you're fitting into some nice little buckets that are helping your investors change up their portfolios so that they're not just heavily focused in one area, but able to diversify. And in the future, there's going to be a lot more of these opportunities, and you just have to decide which one's going to work best for you at the time that you're investing. And liquidity is becoming an issue, 100%. You put a lot into these companies, even if the companies are growing to be massive, if they don't go to a liquidation from a sale or go to the markets, then you could be holding on this for 5, 10, 15 years. And great, the company's doing awesome, but you never get to liquidate. So you kind of start to wonder, how am I going to keep doing this if I'm not building up all these different avenues? So all valuable information. So that was great. Well, I think, Norman, I'm going to have to say that was fantastic. I really enjoyed learning more about you and the investments. I'm sure we could talk for many more hours on diving into all of these different pieces. But like I always say, I've taken lots of notes. So there's lots of good material here that we're going to splice and put together and send out over the upcoming months. But I wanted to thank you very much for your time. And I'll turn it over to you for one last, moment, if you want to share anything that you want to say to startups that you think will help them think a little bit outside the box or whatever that might be. But I give you the last word.
I would just say to the startups that, the key that we've seen to those that have been successful, aside from all the obvious elements, that we've sort of talked through here, is really persistence. These are never, things never go in a straight line. It's always going to take longer than you think and maybe a bit more money than you think to be successful. But if you've got, that right product or service, stick with it and you'll get there. And all the successful entrepreneurs will tell you it was never an overnight success story, right? So just have to be realistic, and persistence is very, very important.
Perfect. Well, on that note, thank you very much, Norman. I wish you a fantastic day, and we'll keep you posted on when everything is ready to move out the door for you, and we'll share it along.
Great. Well, thank you.
Awesome. Perfect. Thank you, Norman.
Okay. Bye.
Enjoy your day. Well, there you have it. Fantastic interview from Norman Light at Light Capital. And I think just to kind of iterate a few things is that when it comes down to investment, the real thing you got to look at, and he mentioned in the last word, which was being persistent, driven to make success, pushing hard, making sure you're coachable. But I think the key to all of this is always about being coachable. But he made a great point, which is find out about that product. Make sure that product zings and that people want it. So you really got to do your homework. Make sure that when that product or MVP is launched, that your customers are really back behind it, which means you really have to have customers right away from the beginning. So I think overall, I'm pretty highly excited and impressed with all the information that he shared. And I think that it's going to be a great video to share. But I think he left us with some great things to think about. Get some help. Talk to the experts. They're going to give you a little bit more insight and broader view into the world. Let them build some comfort, build a fantastic strategy, work with your customers, giving your customers the right mix of what they need in order to accept and love your product so that the investors can come on board and see what great things you're doing. And be persistent, keep kicking butt. And don't take no for an answer. Make it work. All right, everybody, enjoy your day, and thank you very much for checking us out. And we'll see you guys another time this week.